Gold has had a bumpy start to 2026. It began the year strongly, but since then, the market has gone through a sharp reset. The key message is this: gold is still structurally supported, but the near-term macro backdrop has become more challenging. Higher real yields have been the main pressure point. A firmer US dollar has added to that pressure, and after a strong rally earlier in the year and of last year, positioning has become a lot more stretched. So while gold is often seen as a safe haven asset, it does not move in a straight line. When real yields rise quickly, the opportunity cost of holding gold rises as well. That has weighed on sentiment, especially when ETF flows slow and investors start to take profit. Importantly, this is not only about whether the Fed actually hikes rates. Sometimes the repricing itself is sufficient. The 2013 taper tantrum is a useful reminder. Back then, the Fed did not hike immediately, but gold still fell sharply because markets reacted to the surprise signal that the Fed would begin tapering its QE program. Real yields moved higher, the US dollar strengthened, and the ETF liquidation became heavy. Today is not a perfect replay of 2013. The starting point is different. Policy is already restrictive. Real rates are already much higher, and not every piece of hawkish Fed rhetoric will necessarily translate into actual rate hikes. That matters because if US data soften or if the Fed's hawkish tone does not turn into action, markets may start to unwind some of this tightening premium that are already in the price. So while gold remains vulnerable or challenging in the short term, the downside may not be as one way as it was during the taper tantrum. There is also a stronger structural cushion today. Central bank purchases average around 500 to 600 tons per year between 2011 and 2015. But since 2020, purchases have been closer to 800 and 1,000 tons per year. So the support base today is stronger, but the near-term challenges remain valid. Higher real rates, hawkish Fed rhetoric, and a firmer US dollar, as well as softer ETF flows. That is why we are more cautious in the near term, but not structurally bearish. The medium-term anchor is still intact. The latest World Gold Council survey shows that nearly 90% of the central banks expect official gold reserves to rise over the next 12 months, while about 45% expect their own institutions' gold reserves to increase. That reinforces the point that reserve diversification remains a powerful theme. Central bank demand is strategic, persistent, and should provide a stronger floor for gold over the medium term. But we should be clear about the distinction. Central bank buying can cushion gold, but it cannot fully insulate gold from near-term macro pressure. For gold to rebuild stronger momentum, we need clearer signs of the real yields easing, Fed hawkishness to fade, and the US dollar momentum to soften. And more importantly, we also need the ETF flows to stabilize. Until then, rallies in gold may stay tactical, but dips in gold may also find better support than in past cycles because the structural diversification story has not gone away. Near term, we might stay a little bit more cautious, but the medium term, we do not turn bearish. Gold is going through a valuation reset, not a collapse in its strategic case.